Welcome, everyone. Thanks for coming to the panel. We're going to do something different to open. Is anyone a little tired of regulation?
Yes.
Yeah, we will be talking about it, but let's go back. Let's talk about tech. Let's talk about business and the cool stuff for just a minute. I don't usually do this, but I'm going to let the panelists introduce themselves. You have 1 minute to say why your company offers superior technology and how it will change finance. Go ahead, Caitlin.
Caitlin Long, CEO of Custodia Bank. We're a bank that actually takes US dollar deposits, authorized by law to do that. We are very close to launching Bitcoin custody in a brand new way. We will custody actual customer UTXOs. We are not licensed in New York, so I cannot talk business here in New York, but I do encourage folks who want to learn about us to reach out at info@custodiabank.com.
Okay, very good. I'm Lindsay Argalis, CEO of TaxBit. TaxBit is the leading tax and accounting software to help enterprises and governments that deal with digital assets have transparency, visibility, and control over their digital asset activity. We were founded by chartered accountants and tax attorneys, so at the heart, we have a deep respect and discipline for tax and accounting through and through, and we are a modern technology company, and really just trying to help bring compliant adoption to the space.
Hello, I'm Mike Belshi. I am CEO of BitGo. BitGo is a institutional wallet platform and custodian in the crypto space. We've been around for over a decade now, so I think we're one of the older firms here. And we operate across the globe, 4 trust companies, 2 in the US, 2 in Europe, coming soon in Asia and the Middle East.
Hi everyone, I'm Pascal Gauthier. I'm CEO at Ledger. Who owns Ledger Nano in the room? Okay, thank you. For those who didn't raise your hand, ledger.com, you can buy the product online. It's fantastic. This is how you know us, but the best kept secret of Ledger and this industry is probably that we also have an enterprise product, and this is why I'm here today. And the enterprise product does basically what the consumer product does for retail. Enterprise product does it for financial institutions. So we power banks, custodians, exchanges with self-custody technology so they can run their institutional business on top of it.
Since we're talking about banking 3.0, what I'm interested in, another kind of the good themes to emerge has been, the BlackRocks, the Fidelities coming into the space. And here on the stage, I've got a former Morgan Stanley banker, sort of a senior accountant, a couple OG technology guys. As I said backstage, it's nice to have no shady people on my panel. I mean, you guys are, the poster children of good crypto. But when these big companies come in, are they going to look to you guys, or are they going to build their own or go somewhere else? So how is that going to shake out now that Wall Street's coming in for real? Caitlin, you want to start?
Well, most of the big guys are frozen out because in the US of SAB 121, so Bank of New York Mellon is approved for Bitcoin and Ethereum custody, approved by the Fed, but not very active because of the requirement to hold essentially all the custody assets on balance sheet. That does not apply to Custodia. But what you've seen is that a lot of the big banks, because they don't have the software capability, have put together external providers. They're using sub-custody relationships. And as Jesse Powell likes to say, every external relationship is a potential security hole. We've seen that in a couple of recent instances, the Fortress example. That's one of the reasons why Custodia built our own platform. It takes a lot longer to get launched, but it is proven more secure when we see hot wallet hackings coming through third-party vendors that didn't have secure connections.
Yeah, I want to talk about Fortress in a sec because it's kind of a juicy story, but I do want to stick with this topic a little longer. Lindsay, in terms of do you see yourself, a company like yours, getting acquired by BlackRock one day, or will they build their own? Or I know banks, it's always a question buy or build, and I think they usually kind of well, I mean, you know it better than me. What's the story?
Yeah, it is true. I mean, these large financial institutions have huge resources, right? And this is a very strategic area, so they're investing heavily. What we have seen is even by supporting, Fidelity as the client, for example, we have other very large fintechs that maybe started trying to build their own and then realized this is incredibly complex, right? This asset class, obviously you have a very quickly evolving regulatory landscape. There's high price complexity. The traditional systems that the banks have weren't built to deal with this. And so we still see a lot of engagement from the large players, working with our kind of services. The last thing I'll just say is there is something in this space, again, around having a trusted third party, right? We're partnered with like the Big Four, for example, right? So that combination of trusted outside experts also, I don't want to say absolves responsibility, but as long as you're trusting the third party that you're procuring, it actually can be a great situation, at least to enter into the space.
Cool. I just want to shift again, and I want to geek out on the tech for a sec. Like, hacking all the time. You guys, Mike, you've had your company 10 years, have not been hacked as far as I know. Same thing, Pascal, your hardware wallet, if it's now being used by institutions too. What is like the minimum standard of security you need to custody crypto assets?
Minimum standard for financial institutions, you mean? I don't know, like this is a very young industry, so right now for me there is no standard in the industry. I tell you a funny story to explain what I mean. We are worst competitor at Ledger. We compete against the Nano. If you understand what the Nano is, we design a $89 HSM, and so there are many businesses that use Nano and multi-sig to do their custody, and it's a bit of do-it-yourself type of strategy at the beginning, and you bootstrap everything because why would you spend money into a custody solution that actually has a cost? And so this is what we are competing with right now. What's happening post-FTX is actually interesting because it pushes the industry towards something that is more enterprise-grade type of solution. And because what regulators and legislators are asking for now is audit trails. It's who's got access to what, like, how do you organize the governance on top of the coin, etc. All of these things that you cannot really do if you bootstrap a solution on top of nanos. And so we're seeing the narrative change, but it's very recent, and it's really post-FTX. So it's only been a few months now that the industry is thinking about like long-term scalability and building on top of real enterprise platforms rather than bootstrapping everything themselves.
Well, I'd argue actually that we have been thinking about it for a while. In terms of course, the technology controls, the security controls are critical. Caitlin mentioned correctly that we've seen some institutions that they think they can buy a few things, do some system integration, and then run a billion-dollar trust company on top of it. Like, it's not that simple. The good news, the traditional financial system is actually quite aware of this. They've been pretty paranoid about just bringing in technology and augmenting their own systems for a long time. That slows them down from coming in. Kind of going to the other question that you asked previously, Jeff, I think it's also why they're probably not going to make it in the long term. So like Fidelity, fantastic custodian. If you wanted to store your assets with any of the companies on this panel versus Fidelity, all things sounding equal, you'd probably pick Fidelity. I would. It's no big deal, right? They got a great balance sheet. But, I met with Abby Johnson back in 2016, I think it was. And I think since that time, they've managed to deploy, product which is about the same as what we had in 2014. So they're just a very slow moving. They're going to have a very small set of products and services. In terms of building full custody, absolutely. You need all these controls. There's, of course, the technology. Then on top of that, financial controls, and then operational controls. And just one last thing, and I'll stop. If you look at the hacks that have happened in our system, it's almost entirely operational security. Yeah. There's fraud and OPSEC. We talk about keys. We talk about multi-sig. We pioneered that at BitGo a long time ago. Multi-sig, MPC, whatnot. Yes, those matter. But the places where we keep failing as an industry, fraud, OPSEC.
Yeah, okay, that's a great segue into Fortress. You guys all heard the sad story of Fortress recently? Okay, yeah. Oh, maybe not. Okay, I'll give you the short version. A company called Fortress sounds pretty safe, right? Ripple just bought them, and then lo and behold, oh, look, there's like $15 million of funds missing, so Ripple backstopped it, so the outcome's okay. Except the fact this is a custody company called Fortress that has lost that. Even worse than that, the guy who ran Fortress ran an entity called Prime Trust, also sounds very respectable old world banking, and Nevada regulators had to shut it down. Guess why? Because the money was missing. So, and Mike, I know you almost bought the company. What the hell happened?
Well, it's a long story, You can see a lot of it from what the regulators have filed at this point. Look, I would boil it up to another interesting issue that's coming to play. When you have small companies that are handling large amounts of money and things go wrong, at the end of the day, if you're dependent on humans with their backs against the wall won't always make the right decisions. And people will be hacked. People will lose access to wallets. Those things happened at Prime Trust and Fortress. But then the next thing that has to happen is a level of transparency so that the rest of us can see it. I know it's ugly, it's terrible for the people that were involved, but you have to stop it at the beginning. And frankly, this is why we need to start separating custody away from trading in the industry, simply to get checks and balances between those functions. And I think you could go and look at every single exchange hack and ask yourself, if we had had that one thing, separation of custody and trading, could you have either significantly reduced the impact of a failure? I'm talking about Mt. Gox, CoinCheck, Quadriga CX, FTX, Bitfinex, all down the line, versus if you had had separate custody.
Okay, I think that's a very good takeaway, the high lessons. You sort of wrote the conclusion paragraph, and that was a very smart and diplomatic answer. But I still want to know, like, what the hell happened? Like, if I understand right, the guy not only got hacked, but then outright lost a bunch of the money too, right? Like, this was when it was Prime Trust. It's just they simply lost the keys. I mean, is there any kind of standardization or certification to call yourself a custodian?
Well, this demonstrates the platform that's being built is just as important as the key management underneath it, right? So key management, critical, has to be done right. You know all about HSMs. You've been doing them for forever. We've been doing them for a long time as well. But the platform on top of it, if it issues out a receive address, which is not in your HSM, and you don't actually know that this happened, you end up with Prime Trust. But actually, I think the reason I diverted away from the technical failure to the people failure is because the magnitude of that kept getting worse because of the human mistakes that followed. And look, that's why I think the humans, we got to get them out of the system. Humans are the problem.
Caitlin, what do you think? I mean, to me, it's just like a one strike, you're out. If you have a custodian and you lose the money, you don't get a second chance. But this guy did. What was your take on it?
Well, there are a couple of thoughts. One is, I think this is even worse than FTX because that was a Nevada trust company, and the state regulators are watching what has happened to the Nevada regulator dealing with two failures. One company actually failed, the other had a failure, and thankfully, to your point on Fortress, from the Nevada regulator's perspective, there wasn't an actual loss of funds because Ripple stepped in to bail it out. But that's going to make the regulators gun shy. And here's one of the problems. Nevada didn't have any regulation at all. And so there wasn't a regulatory exam manual, there were no rules, there was no preparation before they went live, and so there wasn't anybody looking over the shoulders to say, this is not secure, you don't have operational processes and procedures in place. One of the things about New York and Wyoming, the two states that have actual rules in place, is that there are a lot of prerequisites that have to be satisfied before the custody gets turned on. I've mentioned publicly before, we put our 60-day notice into the Wyoming Division of Banking as required by Wyoming statute in April, and we're not live yet. Okay, and we're about to be, but it's taken that long to get the certifications to get live. That is a feature, not a bug. Yes, it's frustrating for us because we'd like to turn it on, but what's happening is testing, independent reviews, and examinations before we go live. So there are benefits to regulation. There's another piece of it, which is that aside from the point we've already talked about, where companies that are cobbling together solutions rather than building themselves, and those integrations were insecure, there's a real challenge with hot wallet versus cold wallet storage. If we step back and say, what's the right Satoshi ethos way to custody Bitcoin? It's self-custody. I don't think anybody would disagree, not your keys, not your coins. Okay, but if you're in a situation where you have to, for whatever reason, do custody, then collaborative custody is closer than a single third-party custodian. But segregated custody is better than omnibus custody, and the hot wallet versus cold wallet, in a hot wallet structure, the assets have high availability for traders, but if you're a holder, long-term holder and not trading, and your assets are in a custodian, and the custodian goes down, and it goes through a bankruptcy like Prime Trust is going through right now, you weren't the problem because you weren't in the hot wallet that got hacked at Fortress, right? But
Caitlin, I just want to cut you off there. I think a couple lessons there is Mike said maybe separate trade and custody, and then
Yes, I
also
agree.
have the regulatory testing framework. One other factor, though, because I was asking a couple fellows beforehand on the Fortress thing, and one explanation was they were cheap. So because custody is, it's overhead, pure overhead. I don't know if you guys will actually divulge your actual rates, but I mean, I'm curious, like, what are the competitive rates for cold storage and hot wallet, and have they stayed the same, or is that a factor in security?
Well, first, I mean, before we talk about the rates, I think the language is wrong, and we're using language that was used in 2014 in 2023. I think that cold storage versus warm versus hot is the thing of the past in terms of technology. And the way that we speak like this is because depending on the temperature, you are more or less at risk, which I think is crazy for an industry. When you use the US dollar, whatever you do, you have the same risk. You're not more at risk if you do this or do that, etc., and you have insurance and that type of thing. I don't think crypto scales if when you do this type of operations, you could lose the coins, and when you do this, you're safer. So it's a pure technology issue where technology needs to be temperature agnostic, and the governance needs to be into the security enclave, where basically your security model should be that not only the private keys are secure, which is like the basic, but also everything that is happening to the private key, every access is also secured. And so you cannot mismanage funds. And so therefore, whether your security technology is connected to the web or not, shouldn't change anything. When you connect it to the web, you take more risk, it's because your security enclave is just bad. And so I think we need to sort of upgrade our thinking on this and know that there is technology in the market today that exists that sort of waves away all these the cold, warm, hot problems, because you work everything into one single enclave, and then the connectivity happens, and you can be connected online like all day long if you want. Doesn't really matter.
That does make sense. So I would like to have a little bit of a comment, though, on the pricing, too. Is there like a floor at which you need to pay? And institutions, of course, if this overhead's coming in, so...
I just wanted to say this first. The second thing is there is a cost.
Yep.
All right, so flash news for the industry. Up until recently, up until 2022, there was zero cost for custody because, you know what, I will take your funds and then I'm going to do something with your funds, and eventually I'll return your funds. And so we learned all in 2022 that sometimes doesn't work and your funds don't get returned. And so now people are actually asking for real custody, like, I'm going to trust you with my money, please give it back to me when I need it. And so this is what's happening. And so now I think everybody agrees that custody has a cost, and actually made it easier for our businesses to have price lists that nobody's challenging anymore. I can tell you that my price list in 2023 is no longer challenged. I mean, commercially it's challenged. Of course, when you sign a deal, you always have a deal to sign, so people will negotiate. But it's not challenged the way it was in the past, because in the past it was like, well, custody goes for zero, right? And you're like, no. So I think it has a price today, which is good news.
Yeah, just building on that. I mean, I think the various debacles over the last 12 months have created this flight to quality, right? So the companies that are serious about delivering good customer experiences that generally want to be compliant will pay a premium. I think a lot of this, we've been talking a lot about the technology and some about the regulatory, but just, I want to go back to Mike's point around like good management practices, right? We see a lot of companies that their data is a complete mess. Like, I mean, the way that they manage, right? They grew very quickly. There's just not good management practices or tool or visibility. Like, oftentimes they're not even malintended. They just can't even tell you. They don't have a good handle on it. So this whole thing around having the tools, practices, and people that have operated in that environment, I think, goes a long way.
Yeah, it costs money. Mike, did you want to weigh in quickly on cost, or?
Look, it's hard to answer cost because of a lot of different products and services. I'm not sure there's normalized. Look. A lot of people expect custody to be commoditized because they've seen that in traditional asset classes. I understand that line of thinking. But find me 2 custodians that offer the exact same set of services, whether that be at the technology level or the coin support level or the integration off to settlement and liquidity and all those types of things. So it's under, right now, a tremendous amount of flux just with the technology changes that are happening. So it's not commoditized. And when you have something that's not commoditized, of course, that comes with cost. Now, staking might be another area that's kind of interesting to look at commodities, where we see like the price is really getting wedged down because the actual service is not differentiable among many vendors. So that does hit custody, because a lot of people want custody, also want to be able to stake it. But custody right now, the pricing is going to depend on what activities you're doing.
Lindsay, I just want to bring in your kind of expertise here. There's some pretty big accounting news in the last year of, you guys are probably familiar, but when Tesla or a company like that or Block puts Bitcoin on their balance sheet, if the price goes up, they cannot mark it, but if the price goes down, they have to mark it. It's an accounting quirk, but I think they changed that. That's a very poor explanation, but we have an expert here. So, Lindsay, tell us what happened, the big accounting news in crypto.
Yeah, no, thank you. So the good thing is that the FASB came out basically with renewed guidance on this that makes public company adoption no longer penalized for this. So before they used to have to take a huge impairment charge, and obviously when you have such volatility in those assets, it makes it very difficult to keep in line with that. And so this now essentially is removing the penalty for public companies and others to hold digital assets or crypto on the balance sheet. And again, I think overall, unlike the tax regulation that was recently published in the US, which there were differing views on, I think in general the accounting standards was very well received by the industry, and we look at that as a step forward in trying to move in the right direction. That's also largely in harmony with the international standards as well. So what I like about that on the accounting side is there's this convergence of US and international standards, which is good for everyone. A lot of these companies, of course, are dealing in multiple jurisdictions.
Very helpful. We're banking 3.0, so it'd be remiss not to bring up stablecoins. Hello, Caitlin. What's going on though with it? It just seems there's been it's so strange. I know in the new interest rate environment, putting your money in stablecoins, you want to put it somewhere else. That's why Circle is struggling. Tether is still amazingly. In the Wall Street Journal today, they're showing they're lending out the reserves again. Like, oh no, don't do that. But here we are. And then meanwhile, I know you've done everything right the whole time, Caitlin, and you're keeping the door slammed in your face. So is there going to be a change in the American environment anytime soon?
Well, it's either going to happen through the courts, which we're seeing multiple cases of which the Custodia one is one, or it's going to happen through Congress. It's not certainly going to happen by the regulators deciding to let things through. Although if you look at, and again, there's so much politics. We know so much that folks have disclosed to us about what was really going on behind the scenes at the White House, because Washington, D.C. is thankfully a sieve, and it's all just crazy stuff. But potentially ice thawing. You saw it with the Fed as well, because they slammed the door shut in January, but then in August, they announced a novel activities supervision program. So it was a hell no with no crack in the door to now a crack in the door potentially being open. But Congress, with the stablecoin bill, it seems like every day the probability of that thing becoming law before Washington shuts down for the election is moving, but right now it's moving up. And here's the interesting thing. A stablecoin issuer would have to become a Fed member bank. And having applied for Fed membership and having gone through that whole process, there is one way to do things if you're going to become a Fed member bank, and that is going to be a shock to this industry, because there isn't anybody who's been through that in the industry who's going to be ready for it. And there are just so many bank-specific things that are just crazy in many ways in the regulation that the real question is, back to your earlier question, is there just so much regulation that de facto or de jure the regulators are really paving the path for the JP Morgans of the world to get there first, because they know how to do it exactly the way the Fed wants it done?
Makes sense. Rest of the panel, you guys want to weigh in on stablecoins, where they're going?
Sure. So stablecoins, I think, are a fascinating thing, because it's going to be the bridge between the traditional financial system and ours. And of course, in a few years, it'll be us acquiring the traditional financial system, not the other way around. But the fact that we have stablecoins demonstrates there's a strong need, strong demand for a global financial system where you can move around even fiat currencies in a much more convenient manner than what happens today. Regulators are sorting this out. It's still shaking. That'll come to fruition as it does. And then the rising interest rate environment has now actually got our traditional financial system starting to think about how do they participate. So there's probably a lot of people in this room that might have had a bank account canceled as part of their crypto company. It's been an issue. The firms that were not ready to bank crypto companies are now like, wait a minute, There's $80 billion in Tether, $40 billion in USDC, another $15 billion at Silvergate. We went to cash because now you can make interest, you can get an interest return on it, right? So, and it turns out that's a product that they're going to be pretty damn good at, right? They know how to deal with fiat. They've got the regulatory components. So I think that we're going to see a number of products coming out. I've been, I don't know, briefed on about a half a dozen of them, and it's from big, reputable firms. This is great because they're going to help bring the dollars to crypto.
Yeah, I believe that. To wrap, I promised we wouldn't talk about regulation, but we have to. It's banking and it's the story. But let's do it constructively. Let's look at it. I think we agree Gensler sucks. The US could do better. But let's look at places that are doing it right. Backstage, Pascal, you were kind of praising Dubai for being innovative. I've got reservations about the Middle East. So, like, I prefer countries where if you're gay, you don't get arrested, where women have the same rights. And so I'm always a little bit wary when someone points to an entity like Dubai or China as the way to do it. I like democracies. So of the democratic countries, who is doing it right? You want to start, Pascal? Or you can say, Dubai is the model, but where do you think is doing it right?
Well, I don't know if Dubai is a model, but certainly the party is between Singapore and Dubai right now, and it's not in the US and not in Europe. So I think the money and I just flew back from Token 2049. It's I don't know, it's 20x the size of this, big screens, all the money in the world. It's a different show and it's a different feeling. Like nobody's depressed and everything is moving. And every company over there, not every company, but most companies have a dual setup between Singapore and Dubai, where, as we all know, the UAE is doing a big push in terms of trying to capture the crypto business, and right now I think there are 2,000 companies that have incorporated in the UAE between Dubai and Abu Dhabi. So it's really big, and there is competition between the Abu Dhabi regulator and the Dubai regulator, which even in the UAE creates tension and a lot more business. So it's true that this is happening why the US is being challenged in terms of regulation, and why Europe is getting ready to launch MiCA. So
the Dubai-Singapore access, that's interesting. I'll grant it that. We just have a couple minutes left. Everyone else very quickly weigh in on, you start, Lindsay. Point to a country you like what they're doing.
Yeah, I'll just try, quickly on Singapore. What I love about it is the same, regulator that is responsible for supervising and making sure that things are under control is also tasked with innovation, right? So I love the fact that they're basically recognizing the role that blockchain and cryptocurrencies have in innovation, but at the same time doing it in a controllable manner and creating that clarity. The other one I would just say too is Brazil. Obviously that has a very forward regulator right now, and so the central bank is taking a very active role in trying to work with large players in the industry again. And so I think that's moving at pace, and they're trying to lead, as they've done with other things, real-time payments and such.
Look, we've got 4 trust companies today. We got 3 coming. So once that's done, we'll have 5 outside the United States, 2 inside the United States. Regulators in every jurisdiction right now are trying to figure out what they want to do about custody and basic regulation of crypto. They're each kind of deciding it similarly, but differently. So there's good competition. The reality is that each of these jurisdictions probably is going to say, your keys need to be in my country. You probably have cultural and language issues, which are in your country anyway. So the idea that there's one jurisdiction that's going to be the one to rule them all for the world, like the United States has had with the so much push and power, I think that's going to fade. And actually, I think for all of us here in this room, we have an opportunity to start to build the network where we can connect people around the globe in ways that no regulator would do on their own. And just a quick example, the US is the 3rd rail of regulatory for crypto. So if you're outside the US, you don't want to move your money to a US-based custodian. You just don't want to do it. It's terrible for US businesses. Yeah. Okay, whatever.
I think that's insightful, more than one. Yeah, it's not, no one should dominate, and I think that's been a problem. I think that's the idea. Caitlin, you can have the last word. What's your kind of, I know how you feel about American regulators. Tell me your dream date regulator.
Well, just to add, the US, don't count out the states, okay? Because the federal government has tried to move in and elbow out the things that certain states have been doing that are welcoming to this industry. That's part of the reason why the state of Wyoming stepped up to defend Custodia in our lawsuit, right? Because there is a real states' rights issue in financial services regulation. And there are certain things everyone just assumes Washington has power. I think the court system might determine otherwise.
Well, okay, there we have it. Dubai, Singapore, and Wyoming. And everywhere else. Okay, thank you very much, everyone.
Thanks.
All right.